Good morning, good afternoon, wherever you're watching from. It's Business Incorporated, live on Channels Television. Coming up, International Finance Corporation plans to ramp up new investments in Africa to $10 billion annually. And Ghana is set to appeal Moody's debt downgrade, claiming data omissions. Egypt's net foreign reserves inch up to $40.980 billion in January. All right, let's kick off the show with trading on the African continent. Kicked off quite positive today at intraday. Nigeria's main index traded marginally up 0.08%, while South Africa's benchmark index was up the most by almost 0.5%. Elsewhere, Egypt's index dipped over 1%, while the Nairobi Stock Exchange closed Friday's session up by 0.24%. Over to the Middle East, our sentiments were mostly mixed. Peep at the Abu Dhabi and Dubai markets saw both indexes trading in different territories. The Abu Dhabi index was down 0.04%, while Dubai's index edged up 0.43%. Still within the region, Saudi Arabia's index was up 0.37% at intraday, while the Qatari index was down marginally by 0.04%. Now let's take a look at the state of industrial manufacturing in Germany. This is the country's most important economic sector. Output edged down unexpectedly 0.2% month-on-month in November. Let's hear more now from Chris Kobe right there in Berlin. Great to have you, Chris. Well, fresh data is out this morning for Germany's industrial production in December. Another unpleasant surprise.
To some degree, one could say so. Industrial production in December is down 0.3% compared to market forecasts of a rise of 0.4%. Now, this decline mainly due to falls in production of consumer goods, energy and construction, and that's mainly because of the persisting problems companies have been having in acquiring necessary parts and products. On the other hand, experts revised the November figures, turning the slight decline into a plus of 0.3%. And on another positive note, overall 2021 industrial production is up 3% compared to the year before, but still well below pre-pandemic levels. Again, December industrial production down 0.3%. Now, these figures stand in some contrast to what the country's statistics office reported on Friday, a surprising increase in orders from domestic companies. They are mostly responsible for German factory orders surging by almost 3% in December month-on-month. Experts had only expected a rise of about 0.5%. It is the second time in a row that factory orders increase after a substantial drop in the fall. Order books in Germany and the companies are full, even more full than they have been before the pandemic hit. Compared to 2019, the level of orders was up more than 9% last year. Compared to the crisis year 2020, it was up by almost 18%. So to sum up the picture, demand is there, but output is still subdued.
All right, Chris, but what do these and other data tell us about the state of Germany's most important economic sector?
The figures tell us that companies, particularly in Germany, are willing to invest again, that they're banking on the economic recovery to strengthen, which is particularly important for the industrial production. The sector accounts for almost 80% of all total production. On that note, we need to keep in mind, though, that problems in the international supply chains remain an issue. There still is a shortage in primary products and essential parts like semiconductors. However, the immense pressure seems to be easing somewhat. One of Germany's best-known economic research institutions, the IFO Institute, says that pressure on supply chains has been declining to some degree, with about 67% of companies certainly polled reporting about problems in acquiring necessary goods in January, compared to 82% in the month before. So the focus remains on getting essential parts to where they are needed, which often does remain a problem. If we take Volkswagen, for example, Europe's biggest car maker, the company is dropping its 3-shift routine at its main production hub in Wolfsburg in Germany. A shortage of microchips had already lowered production to the level last seen in 1958. Now the company has decided that starting in April, the night shift will be dropped, meaning there's less to do for workers. The reason behind that, there simply isn't the necessary amount in semiconductors to build all the cars the company would like to. Volkswagen is talking about a, quote, dramatic underutilization of its production facilities and is likely to stay like that for some more time. Economists say it is too early to talk about an end of supply chain disruptions. Orders may have been increasing, but the challenge will remain to actually fulfill these orders, to produce the goods that customers want. Should the problems recede in the coming months, the German economy and industrial production in particular could see a real boom. Should the problems persist, output is likely to remain below of what otherwise would be a normal level.
All right, financial markets ended on a somber note, Friday with speculations about rising interest rates in the U.S. Gaining traction. How are stocks starting the week?
German stocks are rebounding. The DAX gaining around 0.8% in the early parts of Monday's trading session. The big question remains, what policymakers are going to do with the data at hand. The ECB signaling a more hawkish monetary policy amid record high inflation in the Eurozone and in the United States. The Labor Department on Friday sharply revised up the previous 3 months' readings while also revealing a wage growth surge. Inflation reports this week tipped to show prices rising at a pace not seen in 4 decades. Traders are becoming increasingly anguished about the U.S. central bank's plans to bring them under control while being careful not to jeopardize the recovery.
All right, thanks, Chris Kobe, right there in Berlin. All right, let's head on to the UK now. We see Halifax has just reported that house prices rose by 0.3% last month, their slowest monthly rise since last June. We have Juliana right there to tell us more. Great to have you, Juliana. Well, UK house prices, they've hit a record high last month. Looks like the cost of living squeeze is having quite an impact on growth outlook.
Yeah, I think lots of people will agree with you, Laddie. Good afternoon. Halifax, which is one of the biggest mortgage providers in the UK, just released their index showing yet again that house prices are soaring in the UK. Currently, the average price of a home, if you're not living in London, is about £274,000. Now, this is just shy of £25,000 higher than it was a year ago. And if you go back 2 years, it's almost £40,000 higher. So definitely some people are winning. No surprises that on the FTSE today, the house builders are leading the rise. But it's that 0.3% growth that lots of people are focusing in on. If you go back to November to December, the growth was 1.1%. So this 0.3% is a little bit low and could potentially mean that the house price bubble will soon burst. But we have said that before and it hasn't burst. But I think the time is now different. We've been talking about the cost of living and the squeeze on family household incomes at the moment, which is very, very a huge issue here in the UK. And it's expected to get significantly higher in April when we do see the Ofgem energy bill increase come into force. And we also are going to see a rise in national insurance. So that's a big issue. Also as well, if you look at the price of a home, £274,000 if you're not living in London, that is a lot of money. And for first-time buyers trying to grapple a deposit together at a time when there is such a significant squeeze, we're not seeing wages rising. We're seeing inflation potentially hitting 7.2% according to the Bank of England. Are people going to buy these homes? That's a big question. So yes, there has been lots of conversations about house price bubbles bursting, but this could potentially be a real issue when people start seeing that their wages are not stretching as far as they were a couple of years ago.
I guess the squeeze fires on, but in more positive news now, I see Data from KPMG shows investment in financial tech firms in the UK grew sevenfold last year, about $37.3 billion. Quite interesting. London attracting more fintech funding than the rest of Europe, Middle East and Africa all put together.
Yeah, that's great news, particularly for the Treasury and the Chancellor Rishi Sunak, who's had a pretty difficult couple of weeks. London does remain the cream of the crop and, according to KPMG, still remains the fintech hub of Europe. Now, last year, as you said, $37 billion worth of deals was struck in London. All of the 10 biggest deals outside of America and China, 5 of them were done in Britain. And there were 600 transactions last year. Many of them are mergers, acquisitions with huge fintech firms. So this is really good news, particularly at a time when London is still trying to forge its way forward when it comes to finalising its fintech services, particularly as we left the EU, and in that pretty hastily written withdrawal agreement, there was no mention of the financial services. I know the Chancellor is really trying to reform the kind of ancient style of the London Stock Exchange to make it more competitive, more attractive, more in line with what we're seeing in New York on Wall Street. We're not there yet, but I think KPMG's statement today has really solidified that London is something you can't rule out.
Quite interesting. Well, you talked about the FTSE earlier. How are the markets looking at intraday?
Pretty good, despite the fact that there are very few reasons for investors to be cautious. Not only have we got that global inflation issue, which is creeping up here in the UK, we've also got domestic issues with our Prime Minister Boris Johnson potentially could be booted out of office. That is certainly going to rattle markets. But it seems like investors in the square mile have turned a blind eye to that, and they're in a positive mood in London at intraday. The FTSE All Share is up by 0.20%. The FTSE 100 is also up by 0.20%. And the FTSE 250, that domestic market, is up by 0.26%. In the currencies market, the British pound is down on the US dollar at intraday by 0.25%, though up on the euro by 0.03% and down on the Japanese yen by 0.41%, Laddie.
I guess investors just care about gains right now. All right, Juliana, thank you so much. Enjoy the rest of your day.
Thank you.
All right, let's move on to other markets now. We see shares in Asia Pacific were mixed today, with mainland China markets rising as they reopened following the Lunar New Year holidays last week. Shanghai Composite jumped 2.03%, closed at 3,429 points, while the Shenzhen Component gained 0.96% to 13,456 points. Hong Kong's Hang Seng Index slipped about 0.2% as of its final hour of trading. In Japan, the Nikkei 225 dipped 0.7% to finish the trading day at 27,248 points, while the Topix Index declined 0.24% to 1,925 points. South Korea's Kospi shed 0.19% to close at 2,745. Elsewhere, the S&P ASX 200 in Australia fell 0.13% at about 7,110 points. Shares of airline Qantas Airways, however, surged 4.62% after Australia announced it will reopen its borders to vaccinated travelers this month. MSCI's broadest index of Asia-Pacific shares outside Japan slipped 0.16%. And U.S. stock index futures turned slightly negative in early morning trade after the S&P posted its best week of 2022, boosted by quarterly earnings reports and a better-than-expected January employment report. Futures contracts tied to the Dow Jones Industrial Average lost 85 points to 0.30%. S&P 500 futures were down 0.24%, while NASDAQ 100 futures are notched down by 0.11%. Investors will be watching more earning reports this week, though the blistering pace of the past few weeks will slow. Big inflation data also in the horizon, with the Labor Department on Thursday set to release Consumer Price Index data for January. The report is expected to show that inflation rose at a 7.2% pace from a year ago, which, if accurate, would be the fastest gain since February 1982. All right, after the break, we'll look at more stories on the African continent. That's in a moment. Just stay with us. Welcome back. Still watching Business Incorporated live on Channels Television. Now to next conversation, the International Finance Corporation plans to ramp up its new investments in Africa to $10 billion annually, support of businesses that it sees helping to drive economic recovery and growth on the continent. Let's talk to Matt Kindigan now, Practice Lead, Sub-Saharan Africa at Front of You. Great to have you. So why is this announcement, of extra funding so critical for African economies this year?
So this is a very critical announcement and a very positive one, partly because public finances in Africa are under quite considerable strain. So, I think last week we saw Ghana's credit rating being downgraded by Moody's. We were also seeing a deteriorating public financial position in Kenya. South Africa's government is also facing quite considerable fiscal strains. So this additional financing is very positive because it will, to an extent, plug a gap that African governments are facing when it comes to being able to invest. So a lot of African governments were planning to make substantial investments into their economies to improve their competitiveness before COVID-19. But because of the pandemic, they've had to support the economies throughout the disruption caused by COVID. So this extra financing and investment certainly will provide a bit of a buffer for economies that have struggled throughout COVID.
Quite interesting. I see Ghana is actually appealing that downgrade right now. But which industries will benefit the most from the extra IFC funding?
So the IFC will probably target investment into industries that have the biggest impact on generating employment, raising productivity of the workforce, but also improving competitiveness of specific economies in Africa. So this means that industries that will see the most investment will probably be industries like healthcare, agriculture, but also infrastructure. So construction will probably benefit, but specifically infrastructure investment into transport, ICT, as well as housing. So a lot of these industries, especially ICT, financial services, have seen a lot of private sector investment already. So we have seen very positive trends with investment into ICT over the last year or so. But what we have seen with industries like healthcare, education, infrastructure, especially transport infrastructure, is that these industries are very dependent on the state for capital and for financing. So these are likely to be areas that will be targeted specifically by the IFC over the next couple of years.
All right, let's. Which countries in Africa are expected to be targets, of this extra investment?
So there's probably going to be a couple of approaches in terms of the countries that are targeted for this extra investment. So certainly the smaller markets, the most indebted markets from a public financial perspective, as well as those with the weakest economic prospects over the next couple of years, will probably benefit the most from additional investment, additional IFC investment. But also those that are specifically struggling to make the adjustments to weaker public finances as a direct result of COVID-19. So a lot of African governments, or a lot of African countries, have quite substantial infrastructure deficits that governments were making fairly substantial progress towards addressing before COVID-19, but they can no longer do this because COVID-19 has really blown a massive hole in their fiscal positions, and their fiscal assumptions from before COVID no longer apply. So governments, so countries with big infrastructure deficits are likely to be a target, but we're also probably going to see the IFC apply its investments in markets where it sees long-term gains for the African continent overall. So, for example, it has suggested that it will be focusing on improving healthcare capacity, but specifically vaccine production capacity. As we've seen throughout COVID, the African continent has been quite vulnerable to supply chain shocks and vaccine nationalism. So it probably wants to address this over the longer term by ensuring that there are improved capacities to produce vaccines locally and other medical devices and products across the African continent.
All right, Matt, but how successful is this extra funding likely to be, in terms of supporting economic growth?
So it will in our view, provide a positive contribution towards economic growth this year and especially over the long term. We really see this extra funding being a really positive driver in the longer term. It will provide a much needed boost to industries and economies that are lacking investment at the moment. And as we've mentioned, specific industries really will benefit. So this will certainly contribute to economic growth, over the next 3 to 5 years. But it's unlikely to be economically transformative in the short term. So although there will be specific industries that will benefit in 2022, 2023, the fact that governments in sub-Saharan Africa and the rest of Africa are facing very significant financial and fiscal pressures does mean that it's unlikely to transform the economic landscape this year or next year. So really, the beneficial focus is more on the longer term.
Right, more of a long term. But does this signal a change in the way multilateral institutions will provide support to emerging markets, including those in Africa?
Well, it really reflects a sort of shifting trend amongst multilateral institutions that governments in certain emerging markets, including in Africa, will need additional support over the longer term to manage the fiscal effects of having to adjust to a post-COVID world. So, we have seen organizations like the IMF being much more forthcoming in providing financial support and packages throughout COVID-19 than we were previously expecting. So certainly we are beginning to see possibly a bit of a mindset shift, but it also suggests some more positive long-term thinking in terms of engagement with African economies. So even though fiscal risks in Africa are really elevated at the moment, so they're much higher than they were 2 years ago before COVID-19, we are seeing, like IFC making a longer-term bet on the region, and despite the fiscal risks, increasing its commitment to these economies that really need additional investment. So our view is that from a long-term perspective, it really is quite positive, but it's too early to tell if this represents a sort of fundamental shift in the way that multilateral institutions engage with Africa. I would hope so, but we'll have to watch this space.
Right, we'll keep watching. You see when the investments start to trickle in. All right, Matt Kinniger, practice leader, Sub-Saharan Africa, in front of you. Always great to talk to you. Thank you so much.
Thanks very much.
All right, moving on to West Africa. Now, we see Ghana will appeal a debt downgrade by Moody's Investor Service, saying it was gravely concerned that the ratings company left out key data to arrive at its decision. Moody's lowered Ghana's long-term debt one step to about Caa1 from B3 on February 4th, citing an increasingly difficult task the government faces in addressing its liquidity and debt challenges amid weak revenue generation constraints. According to Ghana's finance ministry, the downgrade omitted key material information of the assumptions driving some of Moody's forecasts and projections, such as the 2022 budget expenditure control measure, the upfront fiscal adjustments, and inaccurate balance of payment statistics. Calling the move an institutionalized bias against African economies, Fitch Ratings last month downgraded Ghana to about B- from B, saying the government of West Africa's second largest economy has lost access to international capital, which could hinder its ability to meet medium-term financing. And Egypt's net foreign reserves inched up to $40.98 billion at the end of January from $40.93 billion at the end of December. Central bank data shows foreign reserves have been growing since June 2020 after dropping to around $36 billion from more than $45.5 billion, driven by repercussions of the COVID-19 pandemic. Foreign currencies in Egypt's foreign reserves include US dollar, euro, Australian dollar, and Japanese yen, and the Chinese yuan. The provision of foreign exchange involving gold and various international currencies is designed to pay for imports, to pay foreign debts, and cope with any economic crisis in exceptional circumstances. All right, that's it on Business Incorporated. Thank you for watching. I'm Ladi Williams. Bye-bye.